So we'll start with the US where we normally do, and we saw the US Bureau of Economic Analysis. They released the US economy that expanded annualized at 1.6% in Q1 of 2024. Now that was compared to a 3.4% result in the previous quarter, and it was below forecast estimates of 2.5%.
Yeah.
Now this was the lowest growth since the contraction in the first half of 2022. Now in annual GDP terms, the US expanded by 3%, which is down from the 3.1% annual result that we saw in the December quarter. And also a slowdown is seen in consumer spending. So let's have a look at where those slowdowns occurred. So consumer spending, 2.5 versus 3.3, mainly due to a fall in consumer goods, which was negative 0.4 for the quarter versus 3% for the last quarter, while spending on services, and this is where we're talking about it, rose faster at 4% versus 3.4%. Now, rounding out the data, we saw non-residential investment also eased 2.9 versus 3.7. This was due to structures, which was down negative 0.1 of 1% versus 10.9% in the last quarter. Investment in equipment rebounded 2.1 versus negative 1.1, and intellectual property products accelerated 4.5% versus 4.3, thanks to the world of AI. We saw government spending rose way less, 1.2% versus 4.6 in the last quarter. Exports slowed sharply, 0.9 of 1% versus 5.1 in the previous quarter, whereas imports rose strongly. They soared at 7.2% versus 2.7. And then finally, we saw a residential investment jump at a double-digit pace of 13.9 versus 2.9%. So some interesting numbers in there, Evan, in terms of what we're seeing quarter by quarter.
Yeah, and what the theme already you can hear from the US numbers, it's going to be the same for us here in Australia, is that the story is so cluttered. There's so much going on. And, you know, the term I'm going to use over and over in this talk is, you know, it's a box of chocolates numbers. And you can hear in what Ben just outlaid is that things like essentials, they're still doing reasonable. Discretionary items are going backwards. It also, depending on who you want or what you want to listen to, will tell you that this is, you know, an okay story. Some will tell you it's not. And I think that also is what I'm going to start with here is there is an argument on the sort of more bearish side that what we've just got in the US is the start of stagflation. And we're going to come to the inflation numbers in a minute. But having growth at 1.6% is so far below where they needed to be that the path that the Federal Reserve is trying to operate on, which is contain growth without crashing it, get inflation back and keep employment going, is getting very, very narrow. And that is very clear from those numbers. And a growth number at that level for the US is too far below what they need to do. And this is the conundrum that the Federal Reserve, also the federal government, is facing. I think the other thing to really be aware of here is how much seasonality is going on. So Ben highlighted particularly the numbers that are going on in things like residential areas. That is a seasonality number and it will even out. This is the first print because the US has about 3 prints of their GDP before they give you the final number. But overall, there's so much going in here to unpack that it's very hard to get a proper read just on the GDP alone.
So speaking of inflation, we saw the US Bureau of Labor Statistics, and what do we see in the data? Annual inflation rate in the US accelerated for the second straight month to 3.5% in the March data. Now, this is the highest reading since September compared to 3.2% in February and a forecast read of 3.4%. So over every one of the trend lines that they were looking at. Energy costs rose 2.1% versus negative 1.9% in February, with gasoline increasing 1.3% versus negative 3.9%, while utility gas services negative 3.2% versus negative 8.8%, and fuel oil negative 3.4% versus negative 5.1%. Fell less. So what we're talking about here is this whole energy transport sector is where we're seeing inflation being challenged over in the US. Now, we also saw inflation steady for food, 2.2%, and shelter, 5.7%, but rose sharply for transportation, 10.7 versus 9.9, and the apparel reading was was 0.4 of 1% versus flat in the last reading. Now, on the other hand, we saw price declines in new vehicles, negative 0.1% versus negative 0.4%, and used cars and trucks, negative 2.2% versus negative 1.8%. Now, compared to data of the previous months, the CPI rose 0.4%, the same as February, but above forecast of 0.3%. Shoulder gasoline contributed to over half of the monthly increases. Finally, in terms of annual core inflation, was steady at 3.8%, and that was the same as the previous month and above forecast of 3.7%. And the monthly core rate was also steady at 0.4%, yet markets were expecting that to slow to 0.3%. So this is an energy and household story. So it is really a story of the domestic inflation, isn't it, Evan?
Yeah, and so that's what the board, so the Federal Reserve, that's what they picked up on in their March report. And why I say that is there was growing angst heading into their May meeting that happened last week that they could move away from their current projections of rate cuts in 2024. Because I want to highlight that at the start of the year, Ben and I were showing you their dot plots, which is their estimates of the board members themselves of where rates are going. The start of the year, it was 150 basis points put into it. So we're talking about over 5. Now, clearly that was too much in terms of rate cuts. It's now down just to 32 basis points, so 32 of 1%. But on what Ben just highlighted and why I've just given you all that information, what they have said is that exactly that in the inflation story that has come out, particularly in the February and March numbers, is around the fluctuation that's going on in energy prices. But, and it is a but, core inflation is sort of getting stuck. And this is where the term sticky inflation kicks into. At 3.8%, you started to hear them say that they are getting a little bit concerned that they may not reach their target, and their target is 2%. So we're almost double where they need to be. And that's why expectations of rate cuts in the States have moved right out to the end of the year. And we just started to see, and this was Jay Powell's comments, that he's lost a little bit of confidence, just a little bit of confidence that they can return to target inside their time frame. It makes things really interesting over in the US as well, because the current forecasting for that one rate cut this year now is in November. And that is also when we have the presidential election, something that Ben and I will talk to you about later in the year. But it's why this is fascinating, because clearly sticky inflation are things like insurance, rent, housing costs, health, education, things that you need. They are fixed costs to your lifestyle and to your life. They're the ones that are holding it. And I'm going to talk about this a lot in the Australian data as well. But the US is 6 months ahead of us, and it's showing that it's got it right down from where it was in 2022. And you can see that on the chart that Ben's got there. But, and it is a but, they're now starting to plateau out, and they're just getting worried that they may have not done enough yet to get it back to target. And that was the key takeout is, yes, it's an energy story, and therefore it could fluctuate down next month. But there's a core part of it that is still way too high for where they need it to be.
Yeah, I think it's a good segue into what happened with interest rates at the last Fed Reserve meeting. And they did keep the Fed funds rate unchanged at 5.25 to 5.5% at their last meeting. Now, that's the sixth consecutive time that rates have been on hold. And this ongoing inflation pressure and a tighter labour market is stalling the progress for an easing cycle for interest rates in the US. We did hear from Jerome Powell stating he does not foresee a hike as likely and believes that the current policy settings are sufficiently restrictive enough to achieve their 2% inflation target over time. But that is really, the sort of $64,000 question in terms of what's going to happen here in this particular space. And so now we've moved from what Evan was just saying, which was multiple rate cuts. And in some cases, some of those dot plots were forecasting as early as March, April of this year. That's not happening. We're pushing all of that all the way back until we can see that services inflation story move. So I think there's more to come when we're talking about what's going to happen in the US over the course of what you're referring to is an election year over there as well. All right, let's turn our attentions now to the employment story. This one's an important one because this is the one that is, quite a strong story for the US, which is similar to what we're seeing here in Australia. Now, we saw the US Bureau of Labor Statistics also report the unemployment rate in the US has edged up to 3.9% in April from a reading of 3.8% in March. Now, this surprised the market expectations as they'd forecast the rate to remain unchanged. The number of unemployed individuals increased by 63,000 to 6.492 million, while employment levels went up by 25,000 to reach 161.491 million people employed in the US. Now, the labour force participation rate was unchanged at a reading of 62.7, and the employment population ratio decreased to 60.2 from 60.3 in the last reading. So we can see here that actually, losing that number of jobs is by design as they're trying to slow the economy down. So it is this mixed bag that we're seeing in the US, or you refer to as a mixed box of chocolates there, isn't it, Evan?
Yeah, and so again, getting back to what the Fed told us at their May meeting, because you highlighted this before, the original forecast for some people was March, but most people had what they referred to, not lift off, but actually the cut stating was this month. May was the month that the consensus forecast was for to start the cycle of rate cuts, and we're clearly now away from that. But this is part of what they're suggesting is why they're not as hawkish as some people wanted. So that really strong view that maybe rate hikes are back on the table, because there are signs that employment is slowing down. Again, I would much rather use the Bureau of Labour Statistics data than things like the ADP numbers, which is the private numbers. Some people really jumped on that because it was really, really strong. And this idea that wages in the US is also starting to really take off, all of this sparring. Again, this is what I mean by the mixed chocolates. It depends on who you want to listen to, what data you want to collect, because it is noisy, it is loud. And the Fed used that as their term. They used this lumpiness that's going to happen around inflation, this, unstructured fall that we're going to have in the economy as the tightening takes place, hitting certain parts of the economy more than others, and therefore the time it takes to collectively move in the direction it wants to will be different, because month on month it's going to obviously have volatility behind it. So this was their part of their other reasoning, is that they're seeing signs that the employment data is starting to do what it wants. I know it's horrible to see people losing their jobs, but they do need to see that once you have a slightly higher unemployment, it means there's less cash in the economy, because people are now obviously not earning. They're therefore sitting on the cash they have and being quite frugal. So it's starting to show that it's working. But as I said, lumpy, whatever term you want to use, is there. And that's why, again, the Fed is holding off on the view that the next move will be a cut. They said that quite implicitly, but they are concerned that inflation just isn't moving as fast as they were hoping at this point in the cycle.
Yeah, and I mean, obviously that then plays into what we're going to talk about now, which is the consumer sentiment story. So, where the expectation at the end of last year that we were going to see rate cuts, I should say, we saw a nice little spike in the consumer sentiment data, but that's now also plateauing in terms of, until whilst we have this uncertainty about where the economy is heading. So let's have a look at the University of Michigan numbers now, and we saw that they reported consumer sentiment for the US was revised lower to a reading of 77.2 in April from a preliminary reading of 77.9. And that compared to a 79.4 in March, which was the highest level since July of 2021. So we were seeing this spike, but now it's plateauing. So both current conditions, which is one of the internal sub-indexes, 79 versus 79.3 in the preliminary estimates, and expectations was 76 versus 77, declining from the initial expected results that they saw there. So meanwhile, when we also look at some of the other, sort of indexes and the sub-indexes, we saw inflation expectation for the year ahead was revised higher to 3.2% from 3.1%, while the 5-year outlook, and this is the interesting one for me, was confirmed at 3% when we know the Fed are trying to chase down a 2% target. So the consumer expectations, this says a lot about the consumer, doesn't it, in terms of they're saying we'll be happy with a 3. Well, that's not great in terms of long sustained economic growth. You want inflation to be as low as you can possibly get it, where you get that balance right between economic momentum and growth, and that increases the living standards of people in there, as opposed to diluting their disposable income. So that's an interesting story that's developing in terms of, I think, everyone got ahead of themselves, and now we're starting to see that inflation expectation really starting to play with sentiment.
Yeah, and the concern with that expectation, I mean, the RBA used it here. It's a little bit different. The Fed, they haven't used the same term, but inflation psychology, and why the difference between 2% and 3% on a cumulative basis is huge. And let me highlight that. I was going to do this in the Australian section, but we should do it now, because you've highlighted it perfectly, that if if the population starts accepting that 3% is fine, or here in Australia, we're starting to accept 3.5% is fine, you need to put that into consideration. So let me put it to another way to you. If we take the dollar that you had in Australian dollars, this is in March 2020, so that quarter, to the cumulative effect of the inflation data we've just had in March 2024, that same dollar that you had in 2020 to buy exactly the same amount of stuff as we refer to it in 2024, you need $1.17. That's a 17% increase cumulative, and that's about 4% is the average. If you were keep going at the current rate, which we've got obviously in the US, it's currently sitting at about 3.4. Here in Australia, it's sitting at around about 3.8 to 4%, depending on what you want to do. If you keep going on that, in the next 2 years, that $1 back in 2020, you're going to need $1.24 just to do the living standards you had back then. And that's what Ben's alluding to here, is that everything that you get from growing your own personal wealth, your wage, etc., gets completely diluted by the fact that inflation just erodes all that. And therefore, you're not growing, you're not getting ahead. That's the concern. That's the erosion, the purchasing power issue that comes with inflation, and why it keeps central banks up all the time. It's what they have nightmares about, and about trying to control it. And you can hear it in all of them at the moment. They're just having that nightmare. And that's the best way to say it to you, is that the cumulative effect of inflation is starting to come home to roost. We cannot psychologically accept it as being fine. We have to get it lower.
Yeah, and we'll talk more to that, obviously, in the deep dive in the Aussie data. So moving into, okay, so what's sentiment doing in terms of actual behaviour and action around spending? So we saw the US Census Bureau release their retail sales in the US, which rose by 0.7% month over month in March. And that's following an upwardly revised 0.9% gain in February, and a much higher than forecast 0.3%, suggesting consumer spending remains robust. And that's got to do with the employment story. Mm-hmm. So as much as they're, sort of a little bit skeptical, because they've got gainful employment, they're out there spending. So this is 8 of the 13 categories posted increases. So we're not seeing it showing up. So the Fed's got to be concerned about that powerful consumer in the US continuing to spend. So we saw major increases in sales of non-store retailers, gasoline stations, miscellaneous store retailers, building materials and garden equipment. There were gains also recorded in food and beverage stores, health and personal care stores, and food services and drinking places. On the other hand, they were down for sporting goods, hobbies, musical instruments, bookstores, clothing, electrical and appliances, general merchandise stores, autos and furniture. Now, excluding food services, auto dealers, building material stores and gasoline stations, the so-called core retail sales, which are used as part of the calculation for GDP, jumped 1.1%. Now, we are seeing a trend in that data, aren't we, Evan, in terms of, there is discretionary stuff that is being pulled back on. And of course, we have some essential spending there, which is around gasoline, which is fuel for cars and getting around and mobility. So we're seeing the right signals, but they're just not strong enough for us.
Yeah. And so this is why at the moment there is so much interpretation to be had. But the data is showing one thing as a collective. And this is what the whole theme has been, is that we know the right areas are coming down. We know that, what would be described as almost theoretically true discretionary. So, apparel spending, transport, travel, restaurant stuff, that is moving in the right direction. But there are areas of spending that are grey that we have to, deal with, that are discretionary, that are still there. And then, yes, the essential items that we discussed before, they're still reasonable. But also, as you highlighted, we're starting to accept that that's just part and parcel. So if that's just how life is, we're going to spend. And the States is a great example of that whole concept, that they know that they need to slow down, and they are, but they don't want to give up everything in one foul swoop. And that's completely normal and completely natural as a human behavior. It's completely natural in behavioral economics. But this is the catch between the hard, rational thought process of what the technical scenario should happen with rate rises versus the actuals that happen in real life. And again, we have seen similar things here in Australia as well, that sales pop up when they shouldn't, that, the overall seasonality and employment's been better. And the US is basically replicating what we should expect to happen over the next 6 months. And we will come to our retail sales because, if you look at the retail sales back in October, you look at also what happened here at the start of the year in January, those two big negative numbers are what we should expect. But then you've also seen the population, again, accept it and get back to almost inverted commas, some form of normality, and in seeing expansion in spending when it shouldn't be.
Okay, so, obviously that's very much a lag data indicator. We're seeing what's happening on the day-to-day. What we want to now look at is from the business's point of view. So let's do a little bit of a snapshot in terms of what sort of behaviors are changing around business and what they're seeing in demand. So we saw from the Institute of Supply Management, when we take a look at some of the business data, the IMS manufacturing PMI in the United States fell to a reading of 49.2 in April, from a reading of 50.3. Now, remember, anything above 50 expansionary, anything below 50 is contractory. Now, this was firmly below the market expectations for a stall. So this is actually a good news story in terms of businesses are starting to feel a little bit of the pinch in the manufacturing side. So the data reflected contraction in the US manufacturing sector, which failed to maintain earlier traction that they got in the prior month. And it pointed to the first expansion in 16 months. Well, it was a bit of a false dawn. So what we did see was new orders move back to that contractory territory, 41.9 versus 54.1 in March. Pressure by lower demand for textile mills, food, beverage, tobacco, machinery, and electronic goods industries had that contractory component to it. Now, in terms of on the production, was sustained and expanded in areas, in terms of expansionary areas with a reading of 51.3 versus a 54.6. And that was supported by the 19th straight decline in backlog of orders, which was 45.4 versus 46.3. Now, consequently, in terms of lower demand for capacity drove employment levels for manufacturing to drop for the 7th straight month. So here we are, we're starting to see that slowdown starting to show up. So we had a reading of 48.6 versus 47.4 in that employment level. And then finally, for the worrying aspects of this data was the price index. Now this soared to a reading of 60.9. Now that points to the highest increase in input cost pressures since June of 2022. Now that lifted, that was lifted by hikes in crude oil, aluminium, steel, and plastic prices. So all of those input costs, all of those components that make up the finished product, they're really starting to also then flow through, all on the back of higher energy and fuel costs. So it's again another mixed bag in terms of what we're seeing in the business data.
Yeah, and again, that last part that you talked about there can be explained away. So it's import costs that come from the fluctuation and the volatility that comes in, particularly energy prices, so particularly around oil and gas. The overall story that I saw from the ISM numbers is what the board wants to see. What the Fed wants to see is that businesses, as you said, are tightening. We've only had one expansionary month in the last 16. So it is going in the right direction. The catch with it, and you highlighted it around price as well with the import costs, is it's not just in the US story, it's around the world. So if you've got less supply of manufactured goods and demand, although it's falling, is still not falling as much as you were hoping, it is going to create an inflation scenario. It's just general economics and very simple supply and demand. So that's also feeding into this story, is that collectively businesses around the world are tightening, but demand is slowing, but not at the same rate. So prices stay up. And this is the conundrum that we are not just facing in the States or here in Australia, it's across the world. And it's one that I'm watching quite closely because, again, people will and should be able to explain it away. But is this a reason also to keep rates higher for longer? That's all part of the question as well.
Yeah, so, quick summaries of the US market sort of tells us that, this sticky inflation is hanging around, which is, delaying potentially any rate cuts that might be happening in the US and puts a rate hike potentially on the agenda, but a lower risk, according to the Fed Reserve. So,